It's 5 o'clock in London. It's midday in New York, I should say. Midnight in Hong Kong, 2 a.m. in Sydney, 9 a.m. in San Francisco, 9:30 at night in Mumbai, and indeed 6 p.m. here in Torun, in the epicenter, the heart of the European Union, in the middle of Poland. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world today. My name is Patrick L. Young. The IPO-VID live streams, Series 31, episode number 6. That is in the aggregate. Episode number 186 starts here. We got a lively panel discussion for you, but let's kick off with a few interesting and exciting matters a moment. First of all, ladies and gentlemen, anybody in the Philippines, we're thinking about you right now. There's been a massive earthquake just in the course of literally the last 90 minutes, epicentered around Cebu, 6.7 magnitude. Herminia, we know that you were okay when you logged out, but we're sending you lots of love in the meantime, and indeed to all of our team who may be affected and whoever is in and around the Philippines. Not a great month for extreme weather coming in the aftermath of those two huge tropical super typhoons that were also ravaging the region. Ravaging the region in a chemical sense, AstraZeneca have restructured their share listing trading regime, and they've torn a vast chunk of liquidity out of London in favour of the New York Stock Exchange, which is based in the nation trying to do capitalism, the USA, as opposed to the UK, which is trying to do, I don't know what the UK is trying to do, actually. It's a great win for NYSE, frustration for NASDAQ, and a potentially damning blow for the LSE, as actually its stock franchise may be worth next to nothing as the country club duopoly of the United States of America will leave behind a carcass of mid-caps. That said, for all the frustration of the buy side in London, you helped the decline with your job's worth mentality, chaps. Meanwhile, the SEC and CFTC held a love fest yesterday called a joint round table. It was a mega hearing with a star-studded lineup, including Jeff Sprecher, Terry Duffy, and Adina Friedman. And all the mainstream media can talk about today is crypto, which is odd given the fact that the entirety total addressable market of crypto is about the same as the market cap of Nvidia and a little bit of Microsoft. So the top two stocks out of 30-something thousand listed businesses in the world. Meanwhile, NASDAQ, they had a good week last week. First of all, they announced that Uzbekistan, the Tashkent Stock Exchange, is partnering with NASDAQ to upgrade their technology equipment. I wonder, is that going to presage what's going to happen with the UZEX, the Uzbekistan Commodity Exchange, in the near future? And also, of course, huge news in the banking world. Calypso is going to the cloud, and the Tashkent Stock Exchange, that upgrade with NASDAQ Tech, of course. Meanwhile, we can't have a week go by without assessing the latest disaster area, which is the ASX. Not just the 7 Series merger today with Kerry Stokes, by the looks of it, getting away with a massive merger negotiation without even an EGM, which does raise the question of just what is the ASX's regulatory enterprise good for? But the RBA themselves, they issued, through one might argue, inappropriate channels. They didn't actually put it out on the equivalent of the regulatory news service, but instead the central bank went out and, well, they gave an assessment of ASX clearing and settlement facilities as the dull headline worked. But actually the assessment was pretty much nul point if we were on the Eurovision Song Contest Index. Our panel today, ladies and gentlemen, we're discussing markets and IT, and I'm delighted to welcome 3 fabulous guests: Anne Berg, Hamish Adourian, and Daniel Davis. Anne Berg, I think, needs no introduction at this point in time. She's been a regular on the panel sessions. She's a leading expert in commodities worldwide, commodity futures, and food securities issues, a former member of the board of the Chicago Board of Trade, and a leading figure in the UNFAO. Hamish Adourian, returning to the show once again. Delighted to see you back, Hamish. Hamish is the head of sales and marketing at London software house Synara. And last but by no means least, joining the panel today, we have Dan Davis, who leads the sales and marketing efforts at the fascinating vendor who've had many great breakthrough sales in the course of the last 18 months, Connemara Technologies. Welcome to the show, everybody. Let's just do a quick roundup. Anne, where in the world are you today?
I'm in Chicago.
Hamish, where do we see you coming from?
In London this evening, Patrick. And
this evening, yes, welcome. You can tell that's that sort of shadowy background. We're both flowing here, both channeling. And Dan, where do we see you coming from this evening?
Howdy, Patrick. Calling from Austin, Texas.
Austin, Texas. So you definitely win the sweepstakes of the warmest place. Clearly, I'm not in Austin, Texas, given the pullover I'm having to wear at this juncture. So, guys, I mean, very interesting times in technology, seeing what's going on. I suppose one topic of debate that's been quite fascinating is everybody seems to be talking about longer hours. Some people are talking about 24-hour trading. And I'm just curious because it seems to me that that is in many ways a very interesting move for market, but also rather a difficult one to achieve. Dan, talk to us about longer market hours.
Sure. Patrick, thanks for having us on the show. Would love to, give a little bit of background. We provide technology for exchanges to either get to market or improve their technology for a fraction of the cost and a fraction of the time of incumbent providers. Been around for about 3 years and have 15 exchanges running our technology. We've actually recently released a feature called rolling updates where you could take your technology and upgrade it in real time. I mean, this is amazing. We're using a lot of what DevOps engineers would consider table stakes nowadays, like Kubernetes and Docker. But, the exchange software that's out there today, typically has, large maintenance windows and, at least, even in a 24-hour market, I think we're seeing a lot of those are maybe 23 and a half, at least a day or two of the week. So there are some technological challenges in terms of doing like we have with our technology and rolling updates and being able to apply those in real time to the environment. But, I think as I'll make some comments later, this is sort of a snowball, an unstoppable snowball of people who want to transact more. They want to transact on more products and more venues. And it seems like, that snowball's just going to continue to gain momentum. So while it might not make sense for a lot of traditional products or products that are out there today, we're seeing so many new products, new venues that are creating all sorts of secret sauce, hopefully using EP3. But I think for us, certainly from a technological perspective, it's gotten a lot easier to support those markets.
I'm terribly sorry, I'm muted because I was just coughing. Very interesting. Thank you, Dan. So looking at what's going on here, Hamish, I mean, Dan's introduced us by saying, yes, there's lots of demand, there's lots of interest, lots of excitement, maybe not from conventional products. Where do you see the scope or the development or the demand growing for longer and much longer, if not 24-hour markets?
It's a fascinating question, isn't it, Patrick? Again, thanks for having me on the show. Just for those who don't know Sonara, we build software for exchanges and exchange members, clearing houses, and custodians as well, which gives us quite an interesting sort of take on both sides of the great divide, I suppose, between exchanges and those who have to make a living trading on them. I think that maybe go into that maybe later on in the show. In terms of 24-hour trading, I think Dan has covered some interesting ground around how technology can support that. And yes, certainly we need to make sure that things like continuous updates and patches can all be done in real time while trading may still be ongoing. And that's a very important point around how the continuous integration, deployment, and maintenance and support around that is just so critical. Almost in addition to technology, you need the people to be able to handle that and maintain that on a continuous basis. So that's on the deployment and maintenance side of things as well. But obviously the core technology itself, and if you're talking about an exchange that wants to do this, it needs to be able to support that sort of continuous trading. It needs to be able to deal with whether it's breaks, whether it's errors, whether it's mismatched trades, whatever else it is, whether it's taking in orders from multiple sources, for example, all of that needs to be able to be operated on a continuous basis. So clearly there's lots to do, and it's all fascinating stuff for us as technologists, software engineers trying to create these things. And it's a continuous, certainly for Sonara, investment in making sure that we have maintained the up-to-date technology, the capability to be able to support the need, which is certainly there. I think it's a more interesting question on the market structure side of things. So we talk a lot about the trading day, and the concept of trading day has been around for such a long time. In essence, it's almost a curious thought, are we really ready to get rid of that entirely? I mean, if you think of a market, I suppose, and ultimately that's what exchanges are, you have any market ultimately has a place in space and a kind of a time boundary as well. Now, the place in space has long since disappeared, as we all know. But we still have, at least for most markets, there are a good few 24-hour markets, but for most markets, we have those time boundaries. We have trading start, we have trading close, we have our closing price, we wait until the market reopens. what happens when we get rid of that completely? And is the market still the same? What does it mean? What does it imply? What are the broader consequences for investments? And if you think about commodities, certainly some really interesting consequences we could think through as well. So yeah, lots to do on the technology side, but some interesting implications more broadly on market structure as well, I think.
Very interesting, the whole concept of how it's going to impact market structure as a whole. I mean, Anne, I'm quite fascinated for your take here, because obviously it's not that long ago that some of the pits in Chicago, the grain pits, if I seem to remember correctly, barely opened for 4 hours a day. And suddenly we're being told that, instead of working at gentlemanly sort of 10:30 to 2:30 or whatever it was, we're going to actually be expected to be looking at 24-hour markets. What do you think are the underpinning issues, not from the technological standpoint, but from the overall structure of the market issue? Is this really something that ought to be ubiquitous for all kinds of markets?
Oh, Patrick, you know that I'm the techno simpleton here, so I'm not sure that I'm going to be able to answer your question very properly. But yes, you're right. We used to just have a 4-hour day, I think it was, and we felt that was sufficient. And then it was opened up overnight. Also, during that time, the trading card, the big technological change of the trading card was that instead of using a pencil, you had to use a pen, so that the marks would be indelible, and that was the best way to really have an audit trail of the trading that you did for the day. So, I in some ways, I think I'm stuck in the past of thinking that the flows into commodity just are not the same as they are into the financial world, which is truly a intergalactic kind of space where money is flowing nonstop for more abstract types of securities as opposed to, let's say, commodities. I think in trying to answer your question, I think for some commodities, 24-hour trading just doesn't make sense. They're not liquid enough. If you look over the CME website and look down product lists, often you'll see products that there's no trade whatsoever in them. They're still listed, but it could be that some of those products could deal with shorter time periods, kind of an auction style market as opposed to 24 hours. And the old market making kind of arrangements that used to exist, I don't know if they do anymore. So I suppose my answer would be, I think it depends, of what kind of product that you're talking about. And again, the commodities, I don't think have that same kind of flow of money that this. I mean, I know they don't, as the securities do. So that would be my word on that.
So, I mean, it's very interesting because you say that the whole concentration of the modern era where we've really started being obsessed with what I call super liquidity and all of these instruments that do actually trade monumentally huge volumes. But surely also there must be, a regionalization issue, and presumably particular types of wheat or corn or other commodities that are not readily fungible with the product in, say, Southeast Asia has got to have a much, much more narrow window for its trading day than, say, something which is somewhat ubiquitous to everybody in the world, which would be, I don't know, one of the major currency pairs or the value of the US Treasury bond, for example.
Well, I won't say most commodities, but certainly in the U.S., the commodities markets were developed around the point of origin. So that Chicago was a huge draw for farm produce because it had the lakes, the Great Lakes, where it could flow out of the boats could load up in Chicago and flow out of the St. Lawrence Seaway, or else they could go down the river in a barge and be loaded out of the Gulf of Louisiana. So the point, again, to think about is the origin point. There are other commodities, of course. I think the London exchanges were quick to monopolize on things like cocoa and coffee and sugar and so on that would be delivered then into the northern ports, either into London or else in Rotterdam or Amsterdam and so on. And these were fashioned that way because they were most useful to the large hedgers that become the Nestle's of the world. But they were not particularly. If you think about it, they remain ineffective and underdeveloped for the producers in the market, such as cocoa, um, grown in Western Africa, or maybe sugar. So, but they weren't designed that way. They were designed to help the big institutional players. So you had a split originally of how markets developed in commodities from what you had in let's say, financials. And those are the big markets. There wasn't, when I first started I was an exporter. I was an exporter in the 1970s. So this was right after the Great Russian grain robbery, where Russia swooped in and bought up all of the commodity credit stocks that were government owned. And, that was a completely different era of what was happening, because the United States was the number one, and almost not sole, but it was the number one provider of grains in the world. Soybeans didn't even exist really as a market, but wheat and corn. And that has been in secular decline for 50 years, so that Brazil has surpassed the United States as a soybean and corn supplier to the world. And the U.S. is number 3 in some commodities.
Yeah, which obviously does lend to a very much more globalized market and a completely different pattern to how these things are done from where we were at the CBOT, say 50 years ago or thereabouts. And it is interesting, though, because what you're talking about, particularly with agricultural commodities, and by the way, ladies and gentlemen, you are joining a panel discussion. We're discussing markets and IT with the fabulous Dan Davis of Connemara, the incredible Hamish Adurian of Sonara, and our commodities doyen Anne Berg of, Chicago, and someone who has illuminated so many of these discussions in the past. It's interesting when we move the conversation, say, from agriculture into metals, Hamish, because there you have seen a lot of extended trading taking place. And obviously the evolution of the LME's clearinghouse has allowed a much, much longer trading day outside of the pure ring fixing. But it's also very interesting because it seems to me that metals retain remarkably unique characteristics about the way that their trading day over 24 hours is evolving.
That's true. I think in terms of the LME market and metals, there's so much we can look at there around how liquidity is certainly evolving over time. Certainly exchanges are looking to bring more of that liquidity, more of that trading on exchange. There are other pressures in other parts of the market, looking at how they can make the most of some of those trading flows. And it's interesting to think that, so we're talking about the LME, and Sonara have worked in the LME ecosystem for many years now, and we see incredible changes around how a lot of these trading processes work. Whereas in the past, you may well have had the traditional phone calls, and a bit of chat, email messages, and so on. Increasingly now we're seeing more digitalization of some of those trading flows, more automation, whether it's within capturing orders, sending them to the exchange. There's a lot of internalization, certainly in the LME market. That makes a certain feature of that market specifically. But there is a broader understanding that people need to digitalize more, they need to automate more. And that's not necessarily about, this come more next generation things, I suppose, like tokenizing metals. And that would be an interesting thing, wouldn't it? But it's really just about taking the current flows and making them more digital, more audited, in a way that all the different market participants can actually access positions, for example, in real time, access valuations in real time, make better use of their margin as well. And that's certainly not just in the LME market, but globally. There is certainly a trend in clearing market. I know maybe we shouldn't talk too much about clearing houses, stick to exchanges, but certainly there's an important relationship there. Clearing houses certainly are also looking at seeing how they can essentially make more monetization of some of these new trading flows, some of the new participants as well that are coming onto the market. So there's a huge amount going on, and certainly from the tech perspective, there's opportunity there to replace some of the legacy systems that are holding back some of these market participants from fully being able to participate in them.
And it's very interesting. I mean, I think the way that the LME market seems to me to have evolved, because you get these sort of periodic sort of 4 or 5 hour spells where particular regions seem to be very, very, very busy. I mean, the Chinese and other Southeast Asian people are coming in, obviously in the very early hours of the morning, but then they more or less don't seem to overlap in their trade terribly in the LME, or maybe this is just my mistaken imagination. They don't seem to overlap overly with, say, the Indians who come in while it's still basically Asian trading hours. And then you sort of, the Indians all seem to, or the people who are in that general sort of central Southeast Asian region above the likes of pure Southeast Asia, China, Hong Kong, etc. And then we sort of get into the European day and so on. That seems to me to be how the rolling trading has evolved at LME, but perhaps I'm entirely inaccurate.
Yes. Yeah, I mean, there's a lot of the participants will have offices around the world. They will have exactly a set of procedures for handing off trades, quite elaborate mechanisms sometimes to be able to do that. And it works. And there's longevity, there's depth to a lot of these processes, a lot of the relationships within those markets, regardless of whether the members are serving more physical participants, more speculative participants, and so on, or indeed a combination of both, and some very interesting combinations as well. But yes, there is a lot in there that the technology, again, if we are talking about it from that angle, has to support as well. So say the state of an order can be correctly transferred, or if you're moving from one desk to another, or if one office is closing and the other one is taking over, that needs to be transferred correctly. And again, these are areas in which we've done a lot of work over the years as well. So yeah, it's definitely an intriguing market. And I know Anne and I were chatting beforehand, certainly it's a unique one. We're very pleased to serve that community.
Yes, it is a very unique marketplace overall. And I think one of the things that is interesting is that we can see how super liquidity can manage to evolve across multiple different forms of market platform and model. We're not seeing a unique, homogeneous model breaking out. And I'm sure, Dan, you can give us some very good examples there, because just within your own client base, you're seeing Connemara EP3 being deployed in really very different ways over extended trading hours by your trading community.
Sure. Yeah, that's a great segue. And I'm still thinking about some of Anne and Hamish's comments, learning a lot myself. And, with Anne and Hamish, I think they've both talked about maybe more traditional market structures and market participants and intermediated venues. And to Anne's point, cocoa farmers have rarely even tasted the chocolate that they're producing. And a lot of that money goes to maybe the corporations or people that are creating that market and have built that infrastructure. At Connemara, we're really passionate about opening up markets that can help put money back into farmers' pockets and providing the technology for emerging and frontier countries to do that. We're also really passionate about helping countries like the U.S. A lot of our customers are CFTC regulated as DCMs or exchanges, and many of those, maybe to Hamish's point, have become clearinghouses as well. So we've had a lot of dual applicants. Connemara Technology supports 3 DCM DCO combination entities that are fairly recent under the CFTC, but that's been, I think, a really successful proposition for people that want to provide new assets, want to have a vertically integrated system, and luckily those barriers to entry are coming down for exchanges to do that and integrate that clearinghouse technology in-house.
So a very interesting pointer, actually, at which I'm going to introduce a question. I'm going to introduce a question which was raised in a previous show and we didn't have a chance to answer it. It came from Amit Dosaya. Amit, I hope you're watching today. Meanwhile, thank you very much to those who've already given us a little bit of love today on the show. It's always useful because that's one way to encourage the AI bots to manage to put this show further up the list of priorities to where we're going. How will AI change middle and back office work, especially trade settlements, confirmations, and reconciliations? Gentlemen, I think you're going to be more interested in answering this than Anne per se. Let's start perhaps with you, Hamish.
Well, this is an area, funny you mentioned this, one big project in this area going on at the minute. It's historically done a lot of work in broker back offices. AI, it's on a general point, I suspect AI has been, you've been talking about that for a fair few years now, first in the context of machine learning, and how we can use large volumes of data to make inferences, make predictions, and so on. Again, more recently, the last couple of years, I suppose the first thing that comes to mind are, of course, large language models like ChatGPT and so on. And I think right across the middle and back office, and some interesting extent of the front office as well, but that's not part of the question today. The most obvious use case really is around market surveillance, which the middle office is around. It's a natural way in which, this is nothing new in that sense. You can use machine learning to try and identify if there are things going wrong in the market, if there are someone's trying to play things a little too close to the wire, and certainly in the back office, helping identify exceptions, helping with identifying if, let's say, things don't reconcile correctly. There are little things that you can do. I don't think, certainly not in the short term, there's anything that will revolutionize any of these things. But I think it's almost, you don't be careful saying this, but as with many of these technologies, you can almost end up overestimating, what impact it will have in the short term, but maybe underestimating what impact they'll have in the longer term. Certainly for now, I think what people really want with your middle and back office, and especially with your back office, is super strong reliability. So certainly from Synara's point of view, we're not rushing to introduce any exciting new components in our back office, given they are such critical systems. And it's more the front office where, if you're looking at, for example, how can you take chat input, for example, and run an LLM around that. So there are some interesting small projects around there, interesting projects around looking at audit trails, historical trade records, and trying to extract useful information out of that, for example. So there's lots of good things there. But yes, super careful, especially on the back office, given that's such a critical piece, and often people will not touch that system for decades. So getting it right is super important.
Yes, some people won't touch it for decades, and unfortunately, if you're the Australian Stock Exchange, you forget about it for decades, and then you come back to touch it, and it all turns into a complete and utter unmitigated disaster area. But I mean, you're right, Hamish. I mean, people do not need to be tinkering and playing with ultra low latency back office systems. It's just not something you need to worry about. You need to make sure that it's safe, secure, and ultimately works for the end users. Let me say thank you very much to various of our viewers. I see we're getting some feedback as we go along. A very elegant thumbs up from the inexorable, the unsurpassable Ulf Axman out there, a man who I sure needs no introduction to. Many of you in the world of financial markets technology, delighted to have you watching the show, Ulf. And a cheery wave from Dan. And Dan, I mean, it's a good point, isn't it? I mean, looking at the difference in terms of what needs to be updated, and indeed how AI can play a role in the technology of now, as well as the technology of the future.
Hamish had a point about just needing reliable back-end technology, and I think that's true. They're probably applying AI to farming and tractors, but I think the plow remains the same. So for our business, when we're doing an implementation, there's a lot of testing that goes into making sure that the systems operate as you would expect. And I think AI is really powerful for being able to spin up those scenarios quicker. Like Hamish had also said, market surveillance is a huge piece. So if you can have AI trading or bots to essentially go rogue, then that might help you catch some edge cases that you wouldn't have found yourself. We provide a market surveillance product as part of EP3 that also looks at the operations of the exchange, not just the participants in the exchange. So it's, I think maybe more holistic from that front. If there's new exchange employees that have gone rogue and moving balances around or things to that effect. But, in terms of integrating AI, I think some of the most exciting applications would be on that front end. What is, the UX of trading look like in the future? Can I run algos as a retail investor? I think you can already do that today, or AI trading or bots. I think that further democratizes markets, to Anne's point earlier, and maybe just what we've seen with disintermediation over the last couple decades.
Very, very interesting points, Dan. And therefore, at this point, we're halfway through the show, ladies and gentlemen. If you've got a question for our panel, type it in now while we bring you this week's short video. And we're looking towards something not so technologically related. Let's let the video play itself out.
Meanwhile, in Big World, for all the talk of Disneyland as being that extravaganza of a theme park that everybody wants to talk to, in the USA, the latest rankings reveal the Traveler's Choice winner in America as being Dollywood for the third time in 4 years. The Appalachia theme park was co-founded by legendary singer and actress Dolly Parton. It's located in the Great Smoky Mountains of Pigeon Forge, Tennessee. Dollywood features rides in a water park alongside a museum showcasing Dolly Parton's costumes and memorabilia from her epic music career. For more in Big World, like or follow.
So there you go, from the heart of the Smokies to the heart of travelers everywhere. Dollywood is once again America's Traveler's Choice winner. I'm not sure Dolly Parton and AI often gets an outing in the same sentence, but it's quite interesting to note at least she's entirely alive, unlike perhaps the Deutsche Börse CEO, who I noticed was on the airwaves earlier today talking about AI, I think only to try and prove the fact that he isn't an AI bot. But anyway, do subscribe to the Exchange Invest newsletter for all of the latest news and updates, not just our Big World teasers. Meanwhile, in our finance books of the week, let's keep catching up. Through September the 13th to 19th, we had The Blunders of Our Governments, an epic tome by Anthony King and Ivor Crew, hilariously entertaining or gut-wrenchingly appalling, depending on how much tax you've had to pay in the near term. Meanwhile, The Greatest Ponzi Scheme by one of our recent guests, Dan Mitchell, catch up his fantastic show talking about the Millet Revolution all the way to Washington, D.C. from just a couple of weeks ago, along with its co-author, Les Rubin. He was making the case that the American public is being swindled by a federal government whose never-ending, out-of-control cycle of wasteful spending is putting the U.S. economic cycle in peril. So, two sides of much of the same banana, ladies and gentlemen, in terms of what we were looking at this week in the course of our best books. And we return to the panel with gusto. Now, Dan, you raised a fabulous issue at the very start of this conversation. You were talking about products and the new products that are happening, which I think is really, really excellent. I mean, walk us through a few of these interesting and dynamic new markets that you've been powering in the near term, because I think it has got huge implications for the longer up to 24-hour day trading debate.
Sure. I think the headline is people want to participate in their personal economy. And what does that look like? Is it a halftime performance at the Super Bowl, or, is it trading on the energy that's, going through your house and that you're paying for as part of your utilities? Seen some really neat products that have popped up like that for retail investors, right? With the likes of Kalshi and Polymarket and prediction markets, which I know you're a huge proponent of as well. But I think in addition to these new products, you're also seeing the barriers to entry come down for venues to create new products. So creating a new exchange is a great way to, create a new product other than having to go license it to a current exchange. And you get a lot more control. We're hoping that EP3 and our company has brought those barriers to entry down even further so that people can participate in their personal economy and trade more freely and feel in control and not so intermediated through brokers. I think I'm part of a generation that is so brainwashed on index investing and set it and forget it that it's exciting to see a bit of a groundswell of interest in new products, especially prediction markets and what they're doing with just people talking about, these sorts of assets. Ultimately, it's going to result in the velocity of more money. And, I think, that's the nature of our business. So I can't say I'm too upset about that.
It is interesting. I mean, obviously, having been somebody who was pioneering prediction markets 30 years ago when nobody wanted to listen to the whole concept, it's fascinating to see how they've finally taken off and finally been given the regulatory outing in the USA that they long deserved. And that thing that's very interesting about them is obviously the engagement factor. I mean, I think to be fair, if we walked out right now, whether it's in, whichever city in the world you guys are in during the course of today, and ask people where they think the metals prices are going to be tomorrow, you're probably lucky to get 2 out of 10 people who are going to have a strong opinion. If you ask them where they think the stock market's going to go, you're probably up to 5 or 6 people out of 10. If you ask them suddenly, what was going to happen in extending the metaphor. Well, in the course of the last weekend, here we are in Torun Extra Liga champions of Polish Speedway. I think at least 14 out of 10 people had an opinion on where Torun were going to perform before Sunday night's incredible thrashing of Lublin. And equally, if you were to talk about that sticky thing, golf, that was it. I mean, I think a lot of people were very engaged with that during the course of the weekend, even I do believe the President of the United States himself. And certainly that's something that makes prediction markets a lot more lively. Hamish, where do you see this, landing in terms of new markets, new product markets? Because one thing I notice is that Dan's talked particularly about a very, very retail market element. And a lot of what you do at Sonara, but no, by no means all, but a lot of what you do is in the metals business, which is, let's face it, the most adults-only trading environment pretty much on the planet.
Yeah, it's quite good actually picking up on Dan's point about the role of brokers, intermediating brokers, and also on the role of clearing houses. It's interesting, we were talking about 24-hour trading earlier, but we weren't necessarily talking about T+0 settlement, which is often the other thing that sort of goes in conjunction with that. Are you reading 24-hour trading and then are you doing settlement T+1 or T+2 or whatever else? So there is the role in sort of the brave new world, both of brokers themselves, the traditional exchange member, and then clearing houses. How does that evolve in a world where things are more digital, things are more real time, things are potentially going towards 24 hours? And I think what they will all have to do, certainly our customers, many of the businesses work with both metals and non-metals as well, is evolve that role. It's business at the end of the day. Markets change, and if you don't approach that change and innovate and find new ways of serving your customers, find new customers, and ultimately they won't succeed. And thinking about some of the things I was talking about earlier around digitalizing workflows, finding new ways of capturing smaller orders, for example, being able to process more, being able to onboard more customers, and so on. All of that essentially, and then provide additional services, whether it's advisory, whether it's credit lines, whether it's extra internalization, more customized trading approaches that a retail investor or even say an institutional investor may not necessarily be able to do by themselves. So they will have to evolve their role, especially as more liquidity, say, goes on an exchange, and this is across markets. And certainly for the clearinghouse as well, if all of a sudden you have T+0 settlement, because clearing and settlement are subtly different things. You do still need that level of trust in there as well. And again, I think as I mentioned earlier, many of them are also looking at how to evolve that role and provide additional services. So an ever-changing market, and certainly at Sonara, we're looking to provide on the exchange, the broker and the clearing side with components from our Sonara TLC suites that can help them both improve their internal operations, but also be able to provide some of these new types of trading platforms, new types of order management services, for example, to be able to actually offer new services both to their current customers and to new ones as well. So ever changing, certainly, technology provides a key role in enabling that as well.
Ever changing with the technology provider enabling. Go ahead, Dan.
I hate to talk too much about some of our other interesting customers, but we do have Figure Markets, which is not CFTC regulated. And, when it comes to clearing and that world, it does look a bit different. And to Hamish's point, and clearing and settlement are different. But in a world of blockchain, you can essentially pre-clear, pre-trade, and settle in real time. So when we are talking about the money of velocity, just continuing to accelerate, I think that's really what blockchain has to offer. T+0 settlement, real time settlement. And then I guess there's another product, perpetual futures, I think is really interesting in terms of further maybe disintermediating some brokers and maybe hurting. How I understand it is maybe you wouldn't have to roll those contracts, which is a kind of a franchise business for a lot of those brokers. So I'd love to also just hear thoughts on perpetuals and from this group when it comes to maybe commodities or more traditional business.
I think that's a great question, actually, Dana. I must admit, I have a lot of concerns about perpetuals, not because of the product itself, but because I can think it's going to blow up in people's faces. But I know Anne is itching to.
No, I'm not itching to. I find it just as confusing, Patrick. If you have perpetual, so maybe my comment is more of a question. If you have a perpetual futures, to somebody who's used to having delivery as what we used to call the hammer, so that would actually force the price convergence when you had that. How does it work with perpetual futures? What does the hammer look like to force cash and futures convergence?
So how it works within perpetuals is there's a thing called a funding rate, where essentially that it converges it back to spot, where if you are, let's say, long and it settles, it needs to converge back to, and you've essentially won your perpetual, then the loser, whoever went short on the perpetual would be paying the winner that funding rate. How that funding rate gets calculated can get be either pretty technical or it can be proprietary to the exchange, but it typically rebalances the market to incentivize essentially a balanced long and short market on the contract.
Okay, but how does the cash and the futures converge? I mean, if I'm trading corn and it's right now it's priced at, let's say, $4.20 a bushel. I mean, if I'm the seller, I'm the short seller, and I sell it on the December futures, and I never get out of my contract, then I have to deliver. So, and the buyer, whoever bought it, will have to take that delivery. So I'm just trying to, maybe I'm just not seeing it properly as to how this actually works. And the funding, I think what you're talking about would be the same as rolling forward futures, where somebody would have to be paying interest money and plus storage fees and so on. So that would probably work into the funding mechanism that you mentioned.
And I'm candidly not sure how it works for a physical delivery of a product. I think we've seen perpetuals really common on the crypto side. It'll be interesting to see how they're adopted on maybe more traditional assets, or if at all on physical delivery type assets.
Yeah, I think the problem there you have definitely is the issue that so far all we've seen is essentially CFDs being brought in or perpetual futures, being brought in as an exchange-based funding component element to add liquidity to things that actually aren't particularly liquid, like a lot of the cryptos, because they're quite expensive to deal in due to the innate complexities of the way that they trade. And you may have something more to add.
Me? No.
No, at this juncture you don't. But the other thing that strikes me, I mean, moving on from that part of the discussion, one of the things that interests me is obviously this discussion of T+0, and everybody gets very excited about T+0 and real-time settlement. But how real-time is real-time settlement? And I think, Hamish was right on the money for me when he said, we're not going to lose the need for clearinghouses. And it's so funny that when I wrote Capital Market Revolution 25 years ago, lots of people laughed because I said sooner or later you'll see we'll have CCPs for equities, which in those days were clearing at about T+3 to T+5. It was years after the T+forever era, but you look at it now, nobody wants to transact in major equity markets without getting a CCP in the middle. And equally, my issue still with the whole concept that T+0 is nirvana, given the fact that actually does mess up with a lot of repo funding and short selling issues, is that, one day is 86,400 seconds. How far can you manage to shed that down in order to say it's T+0? A blockchain, a conventional Bitcoin blockchain settles in about 450 seconds, something like that on a good day. And Hanmag Securities in South Korea blew up in 143 seconds when its balance sheet went from plus 50 million to minus 50 million as a result of an error. And therefore, I do think, don't get me wrong, I think this is great to shorten settlement windows, but I think we have to be very, very careful because an incredible number of things can happen very quickly. And if you've got 143-second window, the first 35 seconds are basically spent going, is that really happening? The next 30 seconds involves tapping the screen or hitting reboot or something like that in order to see, or reload in order to see what goes on. And then the next 30 seconds, you actually realize, this looks real and we have a problem, Houston. I don't know, maybe you can add something to that, Hamish, or maybe I'm just raving.
Well, if you just look at the shift from T+2 to T+1, I know that's happened over in the States, and there's similar moves on this side of the Atlantic as well, in the EU and the UK. it's going from 48 hours down to 24. But actually, if you think about it, it's not really even 24 hours, because if you cut away the time, the actual working day, people's shifts, the actual amount of time that you might have to deal with a problem is suddenly considerably less than 24 hours in practice. And then clearly on the tech side, you need to make sure that systems are able to actually adapt. Whereas if you previously were doing, say, a batch run every 24 hours, assuming it's T+2, all of a sudden you can't just change that to every 12 hours or something like that. You are going to have to do it even more frequently. And you might think that's just flicking a switch, but not necessarily. If your tech is too slow, it depends how long your batch run takes, for example, and the sheer number of processes that we still see that rely on doing everything in one go on perhaps a rather antiquated platform means that even that shift has not necessarily always been straightforward. And certainly some of the work that we've done at Synara with our Synara TLC platform is to try and make sure everything is essentially real time from the ground up, remove as much as possible some of the reliance on these really heavy overnight processes. Because if we are moving to 24-hour trading, longer trading, even at its most basic, certainly T+0, certainly continuous settlement, talking back on the previous topic about perpetuals, in effect, that's what you need to do. It's almost settle continuously, which is very different, say, how a traditional future would work. You need to make sure that you have systems supporting that. So again, great technological challenges alongside that, those market structure changes as well.
Yeah, and I mean, it's fascinating, the market structure changes, because we've seen that with, for example, Brian Hindman, who was a guest on this show a few months back, and he was discussing from the perspective of Blue Ocean, because you look at Blue Ocean, which provides essentially from 8 p.m. Eastern to 4 a.m. Eastern time, trading in US stocks, in US dollars as an MTF or an ATS in America. Overnight in the US time zone, actually all of the people transacting are in the Asian time zone. And they, if anything, have benefited from the move from T+2 to T+1, because what you're saying, Hamish, is the window to talk to your bank suddenly is so much wider when you're still working during the course of the daytime than it is if you decide to put an order in at 3 o'clock in the afternoon in New York time and you're on T+1. You barely can manage to have a couple of hours to actually get your bank in wherever, Hong Kong or Taiwan, to talk to a bank in New York. Whereas if you actually go the way they're going, which is therefore all of their trades end up being put in a batch at 4 a.m. in the morning, they're fed into the New York Stock Exchange's trade repository for matching and effectively settlement on the next day, which means you get, guess what? Roughly T+2. You get a full business day in between the time that they get to settle, because you've already traded overnight. And it's interesting how that does shift what's going on in the market structure, which I think is quite fascinating. Obviously, that's equities. That is not the same as a lot of the fascinating new things that, Dan, you're looking at. And in particular, of course, prediction markets. There's no real reason why you can't settle a great deal of prediction market trades almost instantaneously. And certainly the ability of somebody like Betfair traditionally, who were much, much better at it than say Intrade, the prediction market I co-founded, has been incredibly successful in doing so. Anne?
Well, I was just going to comment that the futures markets have always called for intraday margin, so there hasn't been the same type of problem because it's futures markets, which, as opposed to securities, are purchase and sale agreements. Makes a very large difference. These things aren't rehypothecated into the marketplace. So there's always been almost instantaneous, not instantaneous settlement, but, for all the time that I was at the Chicago Board of Trade and before, they're essentially mark to market during the day, might, again, necessitate a margin call, or on your statement the next day, everything is settled. So, but I think it's the difference between the two markets of one being securitized assets, and the other is, again, purchase sales contracts.
Yeah, and I think that's a great point.
Which is, I know you want to talk about the tokenization. And to my mind, the tokenization, as I understand it, which is not very well, I'll have to admit, but the tokenization, in a sense, is a way of securitizing commodities again, because you can already, commodities are already fractionalized in the sense that there's mini contracts on virtually everything. But this would be a different way of looking at futures contracts, because there still should be a purchase side and a sales side if they are indeed futures contracts. So I don't know what shape they're going to take, but I'm eager to find out as to how tokenized commodity futures, are they tracking mechanisms that are, again, securitized instruments such as developed in the year 2000, so that you had a corn tracker and you had Deutsche Börse and their agricultural tracker, you've got oil trackers and so on. So you're always talking about the future of markets, and I'm trying to figure out how this particular aspect of markets development is going to turn out. I'm sure my two colleagues have got a much better idea than I do on this.
That's a really interesting point on just making a margin call and the clearing members of an exchange needing to meet the margin requirements in the prediction markets, and to Patrick's kind of question earlier on that space, and maybe what Hamish had talked about in terms of clearing. I think a lot of it does matter about the appetite of the risk of the exchange, and a lot of these we are seeing a fully collateralized model where it is easier to, trade more freely or clear contracts more easily, knowing that they are fully collateralized. So I would say, it adds a lot of complexity to an exchange when you do need to make margin calls, or that you need to set initial margin and essentially have that real time and up to date. That's a lot of calculating that you need to do. And to Patrick's point earlier, things can happen in seconds, microseconds, milliseconds. I mean, it's things can move very fast in markets. So I think the fully collateralized model, just in terms of risk, has taken a lot of that off the table for exchanges, and maybe simplified some of the market structure compared to more traditional futures. Now, if it's a future or a swap, maybe I have less of an opinion on that. Let our customers be product experts.
Hamish, have you anything to add to the tokenization wave or other comments of late?
Tokenization wave. Let's have a little think about this. So let's say if I buy a ton of wheat, for example, a bar of gold. Let's go with a ton of wheat, shall we? Let's go with a ton of wheat. If that's been, say, sliced into, say, 1,000 tokens, what does each of those tokens represent, I guess? And it's thinking from the market structure point of view. Yes, we've eventually fractionalized that ton of wheat held in a silo somewhere. It, traditionally may have been represented by a certificate or a warrant of some sort. So now that's been traded. It's been fractionalized. I've bought a bunch of these tokens. What happens if my wheat disappears? If the quality degrades? What does it actually represent? A specific quantity of physical material in a specific location? Does it represent something more ephemeral than that? And then I guess the biggest question is really, for an exchange, are there going to be enough people, whether retail or institutional, who will want to buy those little slices of the ton of grain to actually be able to create a genuinely liquid market? So I think lots of things to think about there. And it's an interesting comparison, really, if you think about tokens and compare them to, say, something like ETFs, which in some sense could be something similar. But of course, those are, yes, they're fractions of a portfolio, but those are essentially regulators. There's legal backing. You know what a position is. If, say, one of the underlying goes bust, for example, it's less clear at the moment around tokenization. But all these things can be sorted out. But of course, the ultimate question, as with any exchange, is, are there enough people to make a market?
Dan?
I'd agree with that. I'd take an analogy, maybe at risk of taking it too far. I mean, these venues are much similar to restaurants, and you have to figure out kind of what your Big Mac is or your Burger Royale. And, if that is the challenge, like Hamish said, for a lot of exchanges, what is the liquidity or what's that contract that your participants just can't get enough of? And, I think in the world of tokenization, it's tough for products that have questionable fungibility. To Hamish's point, that wheat is a physical good. So if it is damaged or you need to warehouse things, then maybe it becomes less fungible. If you're talking about real estate, is a 4-bedroom, 3-bathroom house is fungible. I think a lot of those would look very different from each other. So maybe there are better applications that could be used for tokenization. I think the fungibility is key. I get excited about hearing about the commodities markets and food specifically when it comes to blockchain and the immutable ledger to see, if there's an outbreak, you can track it to the source of the product. I don't know that really has anything to do with tokenization in the sense of collateral management, but in terms of being able to track things on the blockchain, I think that that entire supply chain is really interesting application for it.
Whoa. Well, ladies and gentlemen, we've had such an incredible discussion today. I think we're going to have to round things up. We've only got about 4 minutes to go. And what I would like to ask you, though, is I'm going to give you a very quick chance because there have been so many trends upcoming that I'm going to give you a quick round of capital market revolution questions and see what element you'd like to pick out, perhaps from this discussion or something else, of where do you think the capital market revolution goes next? Let's start with Dan.
It was fascinating to see that SEC, CFTC, Love Fest, as we called it yesterday, and the changing of the guard. I mean, you see Terry Duffy talking about being a Kalshi user. You see Shane Copeland, sitting next to Jeff Sprecher. It's really interesting just to see the dichotomy of participants at the round table, but also just the ideas and also how receptive to maybe old guard is, as they were called by the Polymarket founder, to these maybe newer ideas. So excited for, I guess, a bit of turnover or innovation here in the U.S. when it comes to capital markets and trading new products for retail users.
Well, it's very interesting. It also says a lot about the regulatory firmament that apparently Polymarkets is a new idea, given the fact it was around 30 years ago. But I mean, it is also intriguing reference to how slowly the blob moves. Anne, where do you think, in relation to what we've been discussing today, the capital market revolution moving next?
Well, I think I said it before that I think that there'll be just much more securitization of old-fashioned products, such as futures. So whether it's my two colleagues suggest that maybe there isn't appetite for slicing up a ton of wheat or a bar of gold or something. I'm sure there's a product out there that everyone's going to want to buy. And I think, as I've mentioned to you, Patrick, sometimes that a lot of this is being driven, I think, by institutions that find a new way of making money. I mean, margins have been cut drastically in capital markets. So this could be a product where you've got the retail sector funding projects such as revenue streams from royalties that you would need to do your due diligence on to really be fully informed. So I think it's moving further. The democratization is fine, but it's moving. It sounds like the markets are moving further towards capturing more retail growth, and that's a sword that cuts both ways.
Fascinating. The concept of securitization, maybe not tokenization, and also I think you win the background noise of the day with that fabulous Chicago fire truck in the epicenter of our discussion as well, Anne. It added a lot of atmosphere.
Got to look out.
Quite magnificent. And Hamish, what about you? Where do you think the capital market revolution is going next?
Thinking about everything we've been talking about over the past hour, really, in a sense, us as technologists, everything that we're trying to do is, make things faster, break down the boundaries, improve the flows, remove the inefficiencies, make it all super fast, immediate settlement, everything else that we're talking about, really. But in a sense, actually, what an exchange is supposed to be is this ordered, safe, unique, highly rule-driven, regulated marketplace with very clear boundaries, and rules essentially is what sums them up. So it's really about how to reconcile the two. So where the revolution goes next, essentially, is where those technological changes will lead it. Yes, more retail participation. That's probably an entire debate given the transatlantic audience that we have, panelists that we have today, certainly more in the States than it is on this side of the pond. So that will be interesting itself to see how that develops, increased retail participation. I agree absolutely with Anne on increased securitization, maybe not necessarily tokenization, but again, the question as ever is how can exchanges do that in a way that actually brings some of that trading, some of the OTC trading that's happening out there onto a regulated venue. And maybe we can provide some technology to help with that. Who knows?
And on that note, ladies and gentlemen, what can I say? Securitization, perhaps even tokenization, the myriad of new products, as Dan has ideally pointed out in relation to how we've got so many possibilities to trade your own passion, as Intrade put it 30 years ago. All of the possibilities within the complexity of commodities markets that we've been outlining today. Thanks to Anne, thanks to Hamish. So thank you very much to all of our panelists. Anne Berg, Commodities Doyen, Hamish Adurian, the Head of Marketing at Sonara, based in London, but operating for markets all around the world, and similarly delivering Connemara technologies to the world from right across the Atlantic, well towards the Pacific coast. It's been a pleasure to host Dan Davis today. Let me say a huge word of thanks to Amit Dossay and Ulf Axman for their input during the course of this absolutely mesmerizingly excellent show, and a huge word of thanks to Janella, Natalie, and Racy. Thank you for being a fabulous team in production. We're going to be back next week. We've got another gripping show. We're going to be talking to Hayden van der Post, and he's going to be introducing, well, now there's a cracker of a topic for us, ladies and gentlemen, quantum finance. Catch us same time next week. Don't forget, if you're missing us in the meantime, you can always read Exchange Invest Monday through Friday. Pick that up via exchangeinvest.com. Thanks again to our fabulous panelists today, Dan Davis, Hamish Adurian, and Anne Berg. We'll be back next week. Have a great week in life and markets.